I would like to discuss balancing growth and value stocks for a well-diversified portfolio. Balancing growth and value stocks, for a well-diversified portfolio. In this context, I want to start with the introduction. And number one, so a balanced portfolio combines different types of stocks to reduce the risk, while aiming for a long-term growth. And so growth stocks and value stocks often have distinctive advantages, and combining both can help, investors achieve a rounded portfolio. And not only that, you discover that by the time you combine both of them together, you tend to have that synergy. You harness the advantages of both classes of stocks. Number two, understanding growth versus value stocks. Understanding growth versus value stocks. So what precisely are these classes of stocks? So when it comes to growth stocks, these are stocks of companies with high potential, for earning growth. That particular high potential for earning growth, they often reinvest earnings into expansion rather than paying, out dividends, and are typically found in sectors like technology and as well as biotechnology. So what about value stocks? These are stocks that trade far less than their intrinsic value, often due to temporary challenges or market pessimism. They may not be, attached to the company's fundamentals. They are usually, in mature industries and may offer a dividend payouts. They offer, regular dividend payouts. Number three, benefits of growth stocks. Benefits of growth stocks. There is this higher potential for capital appreciation. Higher potential for capital appreciation. Growth stocks can provide significant returns if the company's growth expectations are met or exceeded. That is it. So there's this market momentum. Market momentum. These stocks can benefit from investors' optimism and market trend. Whenever there's that's hike in in volume and in price, discover that investors in growth stocks will benefit tremendously. Number four, benefit of value stocks. We've just discussed and benefit of growth stocks. Want to look at a benefit of value stocks. There is number one, undervalued opportunities. Undervalued opportunities. Value stocks often presents opportunities to buy quality companies at a lower price, at a discount, at a price below intrinsic value. The steady income. Many value stocks pay dividends, providing a steady stream of income to their investors. And not only that, there's some lower risk. Value stocks are typically less volatile and can be more stable, especially in uncertain market conditions. During market downturns, you discover that value stocks are more stable. Number five, balancing growth and value stocks. Balancing growth and value stocks. So in this case, you consider risk tolerance. Risk tolerance. And so growth stocks are generally riskier due to their price volatility and reliance on future expectation. They are volatile, they rely on future expectation. While value stocks tend to be more stable, providing a buffer against market downturns. There's this consideration of investment goals. Investment goals. If your goal is aggressive capital appreciation, you may allocate a larger portion of your portfolio to growth stocks. If you want that, aggressive high capital appreciation, you can allocate a higher portion of your capital to growth stocks. For income and stability, value stocks should make a larger, parts or share of your portfolio. You want income, you want stability. In that case, you should allocate a higher, portion of your portfolio to value stocks. And not only that, there's this you know there's this age and investment horizon, age and investment horizon. Younger investors with longer time horizon may lean more heavily, towards growth stocks. They are young, they have years ahead of them when it comes to investing. They can afford to take risk. All right, they can afford to take risk. While older investors, or those closer to retirement may prefer, stability, the stability, and the less risky nature of value stocks. Number 6, creating a diversified portfolio. Creating a diversified portfolio. So in this case, you start with a core allocation. Start with a core allocation. A common approach is to divide your portfolio between growth and value stocks, such as 60% growth and 40% value, or you could allocate equal percentage to both, 50% growth and 50% value. So you adjust based on market condition. You can equally make adjustment based on market condition. So in this case, the allocation may shift depending on the economic cycle. In a strong economic environment, the growth stocks may outperform, while value stocks may provide stability during downturns. You could use this particular concept to equally guide your allocation. You may also consider sector diversification. So diversify across sectors. Growth stocks may provide, and may be more, prevalent in sectors like technology, while value stocks, are common in utilities, consumer staples, as well as in financials. Then consider ETFs and mutual funds. If choosing individual stocks is challenging, not everybody can do that successfully. It involves experience, it involves learning, it involves skills and expertise. So if you cannot do it, it's advisable you buy into, or you consider ETFs or mutual funds that target growth or value stocks. This allows for diversification within each category. Number 7 is rebalancing your portfolio. You rebalance your portfolio. Regularly review and adjust your portfolio to maintain, the balance you've set. You review regularly and make sure that the balance you set earlier on is maintained. If one side, let's say growth or value, outperform, it may become a larger percentage of your portfolio, potentially increasing risk. So whenever you feel that the growth stock is kind of is becoming becoming so prevalent in the portfolio, you can sell your growth stocks and buy more of value stocks so as to be able to rebalance the portfolio adequately. So set rebalancing triggers. So rebalance your portfolio in a set schedule, especially it could be annually, it could be quarterly, it could be semi-annually, or when your asset allocation deviates from your if it deviates from your set percentage, or from a certain, if it deviates by a certain percentage, you may consider rebalancing the portfolio. Number 8, use dollar cost averaging. In this case, you set a particular amount of money, a fixed amount of money you invest at regular interval. It may be quarterly, it may be annually, it may be semi-annually. Just keep a particular amount, a fixed amount ready to invest regularly. Number 9 is in conclusion, Balancing growth and value stocks in your portfolio can provide a combination of growth, potential, and the stability that comes with value stocks. Regularly assess your portfolio based on market conditions, investment goals, as well as your risk tolerance to ensure you are on track to meet your long-term financial objectives.